In accountancy, a debit note is a document used to record an increase in the amount owed by a buyer to a seller. Here's a detailed breakdown. 1. Purpose: correction of errors. If there are mistakes in the original invoice, such as underbilling or omission of items, a debit note is issued to correct these errors. Additional charges. It is used when there are additional costs or charges that were not included in the initial invoice. This could be due to additional goods or services provided. 2. Components. Header contains information like the name and address of the buyer and seller, date, and a unique debit note number for reference. Details of additional items, charges, clearly specifies the items or services for which the additional charges are being applied. This includes quantity, rate, and total amount. Reason for issuing: a brief explanation of why the debit note is being issued, providing clarity to the recipient. 3. Accounting treatment. The issuance of a debit note increases the accounts receivable of the seller and the accounts payable of the buyer. It is recorded as a debit entry in the buyer's books, increasing the payable, and a credit entry in the seller's books, increasing the receivable. 4. Legal and compliance. Debit notes serve as legally recognized documents, providing a transparent record of transactions and ensuring compliance with accounting standards and tax regulations. 5. Communication tool. Acts as a communication tool between the buyer and seller, helping both parties understand the reasons behind the adjustments made to the original transaction. 6. Follow-up. After issuing a debit note, the seller may follow up with the buyer to ensure acknowledgement and timely payment of the adjusted amount. In summary, a debit note is a crucial instrument in accounting that helps maintain accurate financial records, rectify errors, and transparently communicate changes in financial transactions between parties.